Welcome to our weekly Futures and Forex forecast. My name is Jay Norris. As always, we need to remind you that trading is a risky endeavor and not suitable for all investors. I've written a couple of books on trading which were published by McGraw-Hill and serve as the textbooks for our courses. Before we get to the charts, I think it's important that we cover something that serves as the cornerstone for our analysis. That's what we call risk tolerance threshold theory. The theory states that every position holder in the market has a risk threshold level where, if penetrated, will cause them to capitulate, meaning will cause them to exit their position. When you take the average threshold level of all market participants, that level will measure out to the same ratios commonly found in growth curves in nature, i.e. Fibonacci numbers. Most important, whichever side of that threshold level price is on will determine if that market is bullish or bearish. You will find that last sentence very important for you in your analysis in determining which markets to focus on and which direction to trade them from. Let's get to the markets. First market is the Australian dollar. You can see some lines on the right side of the chart. Those are our risk tolerance threshold levels for those time frames. So despite near-term weakness in the Aussie is holding above that day-to-day threshold level, which is marked in green. You got that purple line. That purple line happens to be a 50% retracement of the short-term primary move. So no matter how you cut it, the Aussie dollar remains on a firm footing. You've certainly had short-term weakness relative to the other markets, the euro in particular. We don't want to read too much into that just yet. As long as Aussies are holding above these levels, we have to view this market, we have to respect the bullish footing it's on, and we certainly can see the majority of these patterns, these tradable patterns, in fact even your primary patterns up also. The majority of your tradable patterns are still up, so Aussie's still on a bullish footing as far as we're concerned. Next market would be the euro US dollar. You know, we mentioned the weakness in the Aussie relative to this market. This market, of course, very strong. You are seeing weakness in some of the major markets out there relative to the European currency. We don't see this as a big shift per se. We do understand, though, that when you get accelerated, even exhaustive behavior in a counter trend move, it tends to have a funny effect on the correlations of major markets. We think we are seeing an exhaustive move, certainly accelerated move of a longer-term correction. The primary pattern is still down here in the euro. Let's go out to a weekly chart so you can see the big picture. We've been talking about this for some time. We wrote an article on the Seeking Alpha blog back in December titled The End Game for the Euro Rally, and we pointed out that there was resistance. Our band of resistance, it starts at 135. It's all the way up just below 140. We'd love to see an exhaustive move take those prices up there. You can see I marked the 618 level right there also. These levels are going to serve as those risk tolerance threshold levels. We think that you can take that market up there, especially with the momentum you have currently on the bullish side, and we think potentially you could get an excellent long-term sell setup in line with that all-important primary pattern. You have to be very careful, though, when a market has that type of momentum going up. It's difficult to do anything but trade along with it, and inter-day, that's really the way we've gone. That's the way to view it. Is, you know, you're still looking for buy signals on the way up. Longer term, though, you're getting in a very interesting area on the chart. Here's the daily. Watch that 618 level. We would caution that even if you were to take a shot at a counter trend trade at these levels in here, wait for some kind of topping formation, a double top ideally. Let the market hit that resistance, back off, come back, test it again, then see a shift in momentum lower on a shorter term chart. But for now, yes, we do think these are important levels. We do think you may be able to set up long-term shorts. We think a lot of banking centers will be interested in setting up long-term hedges, that is, going short the market to protect themselves from their loan exposure in Europe. But near term, you have to be very, very careful. A market that's going from accelerated momentum into exhaustive momentum, it's a bit like a wounded animal. it could be very dangerous. So, yeah, we're kind of excited going forward about potential long-term sell setups in here. We think if you get that, you'll see a normalization in the trades, and we think that's why some of these correlations with the Aussie are thrown off, the gold also being thrown off. We think once the euro normalizes, so to speak, you'll go back to the Aussie being a leading indicator market. Those are my thoughts on it, and as always, we'll continue to monitor it for you. So short term, we're still intraday. Short term, we still like the long side. Longer term, though, we're getting closer and closer to that, what we call the end game for the euro rally at these levels. Next market will be pound dollar. Here's another one where, we think that short-term exhaustive momentum in the euro is causing the correlations in the currencies to break down. No doubt about it, the intraday, you want to be working the pound from the short side still. However, you are getting close to these threshold levels, these risk tolerance threshold levels on the downside. Your secondary pattern remains higher, however, as does your primary pattern also. That black line, that's a 618, so you can see the 618 starting to hold. We think if they can pop that 618, maybe clear things out, that potentially sets up a longer-term buy setup, but for now, we're still focused on the sell side. Last week when I did the report, I had a 618 line in there, and I was referring to that as my risk threshold level. That's wrong. The 618 we have in there, that's the black line. The green line technically is that risk threshold level. So we generally look, especially with the momentum down as strong as it is here, to get below those levels, fish around those levels, and knock some stops out. We'll have to see how this one pans out. It's another one where, the question is the pound now a leading indicator on the downside because it's weak? Likewise, is the Aussie weakness telegraphing overall global economy weakness? We're not going to make that decision just yet. We think we're going to be better off letting that counter trend exhaustive move in the euro blow through and then see if the correlations swing back into line. So we're not saying this time is different, basically. We think those correlations will hold out. We just need to see things blow through in the euro. Next market, the yen, and likewise blow through in the yen too. This has just been a monster rally in the yen, and you guys have heard us say all along our long-term target is all the way up at par. And boy, this market happens to be going there a lot quicker than we thought. Now, just because it's a runaway rally on the daily chart, don't think that there's not shorter-term opportunities in there. We were looking at some of them this week, and some of my clients, they're actually pretty good at this. In many ways, they're better than me at it. They're observing more. They're covering more markets. Client pointed out this was an excellent trade right there, and it happened to be right on a 50% level, and it also happened to be in line with all the patterns, and this was just right at the end of the week there too, so you had a perfect here. I'll put the threshold levels on there for you. This is what we call our buy zone, that risk tolerance threshold buy zone. You got in that zone. Look at that beautiful head and shoulder bottom, and this was end of the week. That was Thursday into Friday. Look at that monster move, and that's a pretty simple setup. Nice modest correction right into the zone. Nice head and shoulder bottom. So don't think because you have a runaway market, there's not opportunities intraday, and that happens to be all the way down on a 15-minute chart. So there's the dollar yen, definitely alpha market. And also, we referred to the correlations being a bit skewed here with the Aussie and pound weakness, gold weakness, also intermediate term. We think when this market settles down that those correlations will settle down again. So we're not coming out and saying this time it's different, as we did, by the way, in the late fall and early late fall here, when we said, no, this time it is different for dollar yen. We wrote that article in the Seeking Alpha blog. That was the title of it, Dollar Yen, This Time It's Different. We understand that this is a secular bull market you're in here, but we do think if you get a correction that these other currencies will start to normalize. We'll have to see, though. Nothing is etched in stone. Things change. That's what makes trading so exciting. So, the Aussie dollar, from our perspective, it's actually holding up pretty well long term still. So keep that in mind. Next market, which has really been a beneficiary of the strength in the dollar yen, is the U.S. stock market. Boy, that's been a heck of a rally too, and we were, I think, we've been on record for some time as saying, well, it's probably going to the all-time highs. When you have momentum like that, pointed higher like that, and there's really not a whole lot of resistance up ahead, barring any catastrophic short-term news, we think that the momentum holds and that you'll continue to chug higher in the U.S. stock market. Very interesting in the U.S. stock market this week, you had a terrible U.S. GDP number. In fact, your forward GDP numbers for the fourth quarter of 2012 actually showed negative growth. That's not a good thing. However, the market so far has shooken it off, and we understand when you have a runaway market like that and you have bad news, the bad news tends to attract short-term speculators looking for a correction. Those short-term speculators who sell it end up being the ones that pay up and make and contribute to the market making higher highs. So bad news can actually contribute to higher highs because the bad news will attract speculators into selling into that market looking for a correction, and then they're the ones that end up paying up for it. So that's an interesting dynamic that you have to be aware of as a trader. There's the S&P 500, and we spend time, by the way, intraday looking at this in our live courses too quite a bit now. Next market we're going to cover is gold. Gold's an influential market for us, not necessarily for the reasons many traders think, but gold 5-6 years ago, even longer than that, gold became very attractive for institutional funds. Institutional funds generally have the bulk of their money in blue chip stocks and securities and bonds. They made the decision, this was actually a little about 10 years ago, that the institutional funds, pension funds, etc., needed to have a percentage of their funds in the gold market as a hedge. That number was as high as 8%, for the most part down around 6% for most funds. So if they mandate it, you have to have a portion of your fund in gold. What does that mean? That means a steady bid in the gold market. Now, another phenomenon of this big rally in the gold, and we point out we'll go to a weekly chart, you can see it there. Another benefit of that big rally was that individuals started seeing that they were making money in gold in their savings plans, their pensions. So what did they start to do? They started to put gold into their 401ks, right? So you're seeing a big influence of a big influx of everyday people that in the States here, if they have a 401k plan, they can determine what percentage of their pay they want to put into that savings investment plan. So many of them are opting for gold too. We like gold because we see gold having a steady bid long term. We're on record saying we like that 1650 level. We wrote that article last week, and look at how 1650 held nicely. So we like this whole threshold level right in here. We think 16.25 is a good deal. I'll tell you what, longer term, if you took out 16.25, you flush this market all the way down to 15, we think that'd be even a better buying opportunity. So long term, we like gold because we think we're going to see a steady influx of money, of professional, not just the professional investors in the pension funds, but now individuals that work for Fortune 500 companies that have 401k plans. We think you'll continue to see money coming in there. One more market we want to take a look at that's of interest to us, and that's the corn market. Corn, people have to eat, right? Corn, very important market in itself, but also more so because of climate change. We live in the Midwest here in America. We live on the eastern edge of the corn and soybean belt. Very dry conditions here. If you don't see a reversal of the recent trend in weather, you could see corn going quite a bit higher. It's of interest to us because it got into our secondary zone. We were hoping it would get down to the bottom of that zone, closer to 650. It did not, however. It found support at 680. That's telling us there's strength in this market. So longer term, we're going to keep an eye on this market also. We like that band of support all the way down to 650. So the old saying, rain makes grain. If you don't get rain, corn could be quite a bit higher. They have also have a mini contract for corn too, which makes it tradable for smaller speculators like ourselves. So, hey, thank you so much. If you want to know more about what's going on with us, there's our website. Also, we're happy to be able to tell you that if you open a futures or Forex account with OpenECry, Forex.com, or FXCM, you receive Trading University's 6-month Master's Trading Program for free. And for details, you can go to eostrade.com or email email info@eostrade.com. Thank you so much, and we'll see you next week for the weekly report.